What's up, everyone, and welcome to the Long Game Podcast hosted by Thomas Kopelman and Trayton DeVore. In each episode, you'll hear us break down financial topics that are relevant to the lives of millennials and other young professionals. Our goal is to help bring credible financial information to you in short, bite-sized episodes.
Thomas Kopelman and Trayton DeVore are the co-founders and financial planners at All Street Wealth. All opinions expressed by Thomas and Trayton are solely their own and do not reflect the opinions of All Street Wealth. This podcast is for educational, informational, and entertainment purposes only. It should not be considered advice. Please consult with your financial advisor, tax, legal, and any other advisors you have before making any decisions regarding your financial plan.
All right. What's up? And welcome back, everyone, to another episode of the Long Game Podcast. Today, I'm joined by a very special friend, Frazer Rice. He is the author, and I guess you run the podcast called Wealth Actually. Just a honestly really smart person, somebody I'm lucky to have gotten to know recently. Frazer, thanks for joining me today, man.
Tom, thanks so much for having me on. Hope I can help the listenership get ahead of things. And the book and the podcast are a lot of fun. It's a great way for me to meet people and learn about new stuff. And as I like to say, get 85% smart on some pretty tough stuff. And then I've got people on the line in case it comes up in practice.
Yeah, I actually have your book right over there. It's on the top, and I listen to your podcast all the time. And for everybody, his podcast is really great. Honestly, I think it's a really great resource for advisors. I think I look at my clients and I'm kind of like, maybe they would have no idea what's being talked about quite yet. But for me, I'm like, this is a great place for learning about estate planning and tax planning, just really like a high level that most advisors don't even know.
Yeah. So, I mean, my practice back when I'm a lawyer by background, and I wasn't really a trust and estates lawyer. I did a bunch of other things around banking law and securities regulation and lobbying of all things. And then I worked for Wilmington Trust for almost 16 years. So a really good grounding, I think, in terms of estate planning, multi-generational issues, the intersection of long-term time horizons and wealth planning. And so what I try to do with the podcast is, as things pop up that I think are going to be issues over time, try to get smart about them, because invariably it will come up in one way, shape, or form. And a good example of that is the Corporate Transparency Act, which is a law that's been promulgated, and now the rules are coming out there's a lot of disclosure and confusion about it, and it's something that's going to impact people up and down the wealth spectrum because it involves LLCs and other corporate entities and additional reporting. Anyway, so I used the podcast once it came out, and I kind of got the sense that it was going to be not only sort of wide ranging, but impactful. And I got a lawyer by the name of Stephen Liss on, who's really good at this stuff, and found out a little bit more. And that's what I use the show for. I use it to learn and to get the message out. And it's a great way to meet people and sort of get smart on things that I think are coming around the corner.
Yeah, I'm the same way. I bring on people that have something that I really want to learn. And I know as I learn it, the audience will learn it. But I think maybe let's finish this whole thought that you're having over here on the Corporate Transparency Act, because we already started to tease it, and I was just reading about it today. And so I think this is for everybody to know, right? Because as long as you own more than 25% of any LLC, you have to go through doing this next year, right? And it's basically just letting the government know, here's the businesses that I'm involved in or own. And you have, I think, until the end of next year to do that, if it's an existing business. But if it's a new business, you have to basically do it right away. Is that right?
You're exactly right. And so just some context around it. I don't know if everybody heard of the Panama Papers, which is a big international money laundering situation that occurred basically through a Panama law firm. And, with the advent of the Ukraine and Russia and wealth and using entities to transfer money or otherwise kind of disguise the characterization of people's wealth, it got to be an important enough issue that the U.S. decided, you know what? We need to find out more about what's going on kind of at home. And the LLC world is one where if you start diving into it over a long period of time, you start seeing that there are very good reasons to use them: asset protection, privacy reasons, et cetera. And they're not some not so great ways to use them, which is to build up a lot of complexity and shield wealth from taxation in a not so nice way. So the government said, "Okay, this is crazy. We need to know more." These are entities that report to state agencies, usually the state government authorities, and we might as well understand what's happening there. And the legislation basically said, FinCEN, which is one of the groups that's in charge of this, why not just increase the disclosure so that we understand where things are and why they're in place? And you're absolutely right. So I think the interesting part is that LLCs have been, and other entities have been, pretty inexpensive on a relative basis to set up, and so the knee-jerk reaction has always been, "Oh, hey, we'll just throw it in an LLC." That's a great way to sort of either solve a structuring problem, or maybe set up a tax situation, or shield assets from an asset protection standpoint. Well, now what's happening is that what seems like a pretty easy situation, if the LLC is uncomplicated, could become a lot of work for people. And these are small businesses. These are people who own properties in LLCs for asset protection reasons, et cetera. It covers all of that. And so the idea is the government wants to know a little bit more about who owns things, who set these things up, so that they can begin to build their own database and understand how big the effects are of things, and to frustrate any potential sort of bad actors who might be using these structures to transfer money illegally, or to evade taxes, not avoid them.
Yeah. So in reality, for the average person who's doing things by the book, like, it's not a big deal. It just has to be done, right? If you are the real estate investor and you're setting up LLCs, yes, it's going to take time to go and do the reporting for this. And it's a one-time thing, but this is really aimed at like people who are using LLCs in just like crazy complex ways.
Yeah, so I would say that this law has teeth. So there are financial penalties for being out of compliance, and potential criminal penalties for being really out of compliance. I would caution against it being sort of a do it one time and it's done type of thinking. If there are significant changes in ownership, like if you sell something, or if someone passes away and it passes from one person to another, the IRS wants to know, or excuse me, the FinCEN wants to know who is owning things at any given time. So they want, I think the way the law is set up is that they want any changes that occur in ownership to be reported fairly quickly. The good news is that
is it pretty easy to do? Is it
sure,
like an easy form?
So the form is under development, so we don't know exactly. But what it's expected that it should be fairly easy if it's uncomplicated. So if it's a single member LLC, that shouldn't be a big deal at all. If you have multiple owners and you know who's what and where and why, that shouldn't be a big deal at all. When you have complication, multiple ownerships, maybe multiple shares, maybe you have trusts owning things, or that type of thing, that's when you have to get the flow chart out and understand who owns what and why. And then there'll be some judgment calls perhaps on what that 25% looks like, and who an ultimate beneficial owner is. And that can be, that for more complicated things could be challenging, but it's just something to look out for. Things that have been in place, you have all of 2024 to get it involved. My summary advice on something like that is, if you have an LLC and you had it set up or don't really understand the ramifications of what that is, it might be a good time to sort of get a lawyer involved to make sure that you're compliant on that front, so that you're not running afoul and get a nasty surprise someday.
Yeah. No, and honestly, I mean, the idea makes sense to me. I think this is a perfect example. So, I'm sure you at least know somewhat about like a lot of people moving to Puerto Rico and using the tax laws there to shelter taxes. Like, that's obviously by the book. But I was talking to somebody about it, and they were telling me like, hey, don't worry. if your company doesn't qualify as one of the options here that get the 2 or 4% corporate tax rate, then what you can do is you can set up a management consulting company here, leave your other company in the US, charge them the consulting for most of the revenue, let it flow through here, and you have the low tax rates. Like, I'm guessing that's probably some of the things that this is looking to take a part of people of like, hey, here's ways to go around the tax system that isn't really legal. You're just moving money to a different LLC for certain qualification or tax status.
I think you have it completely right. I think ultimately what it's solving for is coming from a good place. Normally, I don't like government for the sake of government and forms for the sake of forms, and life's too short for that, in my opinion. But in this case, I think the government and the taxing authorities and financial security authorities, et cetera, said, we don't even understand what's out there. We've got these big numbers. We don't know who's what, where, why, and how. And you start looking abroad and you hear about Russian oligarchs owning things all over the place in different jurisdictions and all of that stuff. And I think that rightfully made people uncomfortable. I think it also, you get to here in New York, which is where I'm based, the ideas of LLCs owning apartments and having a lot of secrecy around that, I think started to make people feel uncomfortable as well. And that's what that's trying to address. And so I think this is actually government coming from a good place. As with anything that's new and different and form-based, I think sometimes it can get arduous, and I think that's what we're hoping. We work through the kinks over the next year, and I think the government will. I'm hopeful. I think is a different from my hope statement, but I'm hopeful that the government is patient with the onboarding of millions of different entities. The IRS was just apportioned a whole bunch of money to upgrade all sorts of things. Hopefully FinCEN and some of the other institutions that are in charge of all this, they get allocated the resources to do this in a way that makes it not only convenient for the LLC owners, et cetera, but also something that just doesn't detract from people taking things on.
Yeah. Yeah, I'm with you. I don't hate it. I mean, I think it's going to be a mess in the first year of getting all of this done and figured out and navigated the forms or whatever. But in general, I think it's a solid idea and trying to fix obviously a problem. But okay, cool. I'm glad that we got to talk about that. I was literally just reading more about it today and I was like, oh gosh, I need to spend a little bit more time on there and get on the podcast. So that's perfect. But let's then transition into today's topic. So what we're really trying to think through here is, 2026, everybody's talking about tax laws that are going to change in 2026, estate planning changes that are coming. And so I think, the goal here is that we talk through what those changes are, and then we're going to talk about how to plan for those changes based on different wealth classes.
Yes. So just for some quick background, as a general matter, the Tax Cut and Jobs Act, which was passed in 2016, had a sunset provision. And what that means for people who aren't really sort of diving into the weeds on legal stuff or frankly have better things to do, that means that the law reverts back to what was going to happen in pre-2016 levels. So December 31st, or more technically January 1st, 2026, a lot of different provisions are going to revert back to what was in place in 2016. And what that means is, and I guess I'll sort of start with the major component that's on my sort of front burner, is the fact that the estate tax exemptions revert back to pre-2016 or 2016 levels adjusted for inflation. For those who are newer to the sort of estate tax world, an estate tax, which is linked to something called the gift tax, is a tax on wealth that is passed from one generation to the next. It is started out in many ways as a way to sort of prevent dynastic wealth from just taking over the country. It is also a source of revenue, although a relatively minor source of revenue for the government. And it was put in place to say, okay, the Rockefellers, et cetera, should they really be allowed to pass wealth from generation to generation that maybe wasn't earned, or is a way to redistribute wealth back into the system? Then you have an estate tax based on wealth, and depending on what the value of that wealth is, a percentage is taken out. An interesting issue happened where a lot of family farms and those types of scenarios were brought into the conversation, that an estate tax may not be right for all types of wealth. And so for those people who have farms and family businesses and so on, to have let's call it an arbitrary estate tax in place upon the passing from one generation to the next, and literally requiring a liquidity event to pay for it, are you actually destroying long-term businesses in this country as a means to, decrease dynastic wealth, raise revenue elsewhere? So what's happened over the course of time is that there's been a balance between the estate tax and then an exemption from the estate tax, so that certain wealth up to certain points was exempted, and that allowed for the passing of small businesses, farms, et cetera, from one generation to the next. Now, that's a short version of a very charged topic. A lot of people get very philosophically overwrought on both sides of things there. But the state of the union is that there's an estate tax of 40%, and then there's an exemption that people have for assets to pass to the next generation in avoidance of that estate tax. Now, in 2026, the law was passed that essentially increased the exemption for the estate tax, and it has increased including inflation, et cetera. Right now, 2023, each person, so let's say husband and wife, but husband has 12.92 million of estate tax exemption. Wife also has 12.92 of estate tax exemption, which means a married couple, husband, wife, or domestic partners, et cetera, could theoretically transfer $26 million of assets to the next generation, estate tax free. So this is, generationally speaking, one of the most advantageous times to be thinking about that type of long-term estate tax planning. So what happens now, that's 2023. I talked about before in 2026 how things were going to revert back to the 2016 levels. So essentially 26 million per couple looks like, after inflation and some sort of numerical gymnastics, that it would go down from 26 to 13 million, or roughly that. Let's say 14 million, 13, 14. We're not going to be quite sure until 2026, but essentially that exemption is going to be cut in half. And so for high net worth and ultra high net worth families who have the assets to give away that level of wealth, to relinquish control for the benefit of their kids, there is a lot of discussion about using those exemptions as quickly as possible and locking them in before the turn of the calendar into 2026. Subject, of course, to Congress deciding to change it ahead of that, which every time I've tried to predict that, I've been extremely wrong. But anyway, so that is the fact pattern that a lot of people in my practice are worried about, and that's something that that's what we're thinking about in terms of advising families, as far as how much to keep in their estate for their own liquidity needs, how much to pass out to their kids. And then you get into the larger family governance discussions. Okay, we pass it out to the kids. Well, we don't want to give it to them outright because we're worried they're going to, buy Lamborghinis and do things that don't make sense, and they're not ready for it. How do we have these larger family discussions so that we not only transfer value to the kids, but we also transfer our value system to the kids and give them an appreciation for how that wealth was built, and what to use it for in terms of being able to be productive, be good members of the community, and ultimately be good stewards of the wealth, not just now, but in the future.
Yeah. No, that makes a lot of sense. I'm going to summarize a few points just for everybody to remember this. So as of now, basically as a household, two parents, they have $25.9 million before the estate tax kicks in. But what people sometimes get confused by is the gifting amount and the estate tax limit. They're the same thing, right? So I was explaining this to a client, right? Like if you give $10 million away today, that is not taxed. All it does is reduce that 25.9 million down by 10 million that you still have, left over your lifetime. So that's something that I see mixed up often. And then the big thing is that in 2026, this is basically going to get cut in half. And from all of our understanding so far, you can use up the exemption above what it's going to get cut in half too. And they're not going to go back and say, hey, you used 20 million before, but now it's, 13. Well, that 7 million now becomes taxable, at least from our understanding, right?
Yeah, and in fact, it's more than just understanding. The IRS gave some guidance that basically said that they're not going to claw back things that are made, decisions that are made now that get sort of proactively changed if that comes to pass.
Okay.
Without something like that, then it does really become chaos, because it's very difficult to make plans if you think that 3 years from now or 5 years from now or 20 years from now, the government would unilaterally say, well, that's all fine and good, but we're going to go back and with our erasers and force you to go back and do different things. It also legally speaking, you start to get into the world of constitutionality and whether or not that's as they say in the lingo, a taking, which isn't smiled upon by most constitutional lawyers.
Yeah. Okay. So that makes sense. Really good point. Because that's what I had heard, but I wasn't like confirmed on it. So I think the other part here that gets interesting is that I think when people hear about all these changes, like I think a couple of years ago, we had the whole like, oh, backdoor Roths are going to go away. Right. And everybody was like, oh, don't do them. They're going to go away. And then they did it. The difference between like something like that and this is that it's not that laws have to be passed to cut this in half. It's actually that laws are expiring that are going to make this change. So it seems more likely than not, unless somebody new comes into office and makes this change. And I'm sure if anybody watched the debates, a big thing that was talked about, or Pence talked about, that he's going to extend it, he's going to make it permanent. But like, you have no idea what's going to happen here. Like if, Democratic side wins, there's a very good chance this is going to sunset. Republicans win, there's a good chance that this is going to be extended, which makes it really hard to plan. And so I think...
Yeah, no question about it. I was going to say just quickly that, as you said, the law, without any changes at all, with let's call it total congressional inertia, which is something that many times we can enjoy and plan for. If nothing happens, all the things we just described are locked into place. It doesn't require congressional act or fiat or anything else in order for it to happen. It requires an act of Congress and appropriations, et cetera, for that to change. I tell people whenever they think about trying to handicap whether this is going to happen or not going to happen, number one, we're in such a politically divided situation right now, and presidential elections come down to anywhere from 5 to 15 counties, not just states. It's really at a county level sometimes where these things shift, and that Congress and the Senate are so evenly split right now that trying to guess what's going to happen election-wise, I think is not great from a planning perspective. I think you deal with the facts ahead of you, and you deal with the conditions that you have. And what we have right now is we know with a great degree of certainty that the planning that you do with the exemptions that are put in front of you is going to be fairly durable going forward.
Yeah, that makes sense. And you're right. It's a good point. Like, just because a Republican president wins does not mean that this is going to get extended, even though that's their belief, right? It still is going to have to go through and get passed if they want to extend it or make any changes.
Just a quick story on that. So in 2010, there was this type of thing going on where there was a set of exemption laws that were expiring. And the conventional wisdom amongst dorks like me and political prognosticators, et cetera, was that it was going to get blown away and knocked out. And oh my gosh, if you don't get this stuff done, it's going to go away. It'll be a huge issue. Ultimately, it was extended. And then further down the line, it was expanded. So it was completely different from what everyone predicted. I would say a couple of thoughts on that front for those people who listen and want to handicap this type of thing. The estate tax does not generate a lot of revenue for the government. I believe, if I remember correctly, it's less than 1% in actual revenue. And so it's also it's a complicated issue that does not really register politically with a lot of different voters. It doesn't
Maybe
really,
donors.
it does, but the donors are smaller and they don't have a lot of votes attached to them.
That's true.
And so purely politically speaking, the issue doesn't move the needle that much, which means that it ends up being a really good bargaining chip for other things that do move the needle politically for other people when that horse trading goes on. And so all the more reason, I think, to sort of look at the inertia and say, okay, that's what's in place. And we've got a set of facts in front of us. And then secondarily, we're going to be the last people to know ultimately what's going on. A lot of the horse trading and so on is going on behind closed doors, and we end up usually pretty surprised about what shows up at the end of it.
Yeah, exactly. Well, okay. So let's talk through how you're thinking about this and how you're planning for it. So I think maybe there's going to end up being multiple different groups. I think the easiest place to start, right, is you're way under the exemption limit, right? I mean, if you're, in your 30s or your 40s, you're 2 million net worth, which is still like you're in a great financial spot by all means, like not, downing on that. But there's really nothing to be planning for on this estate tax amount unless somehow you're like, I own a C corp, it's going to boom. I'm moving this into a trust or I don't know, GRAT, there's plenty of options that you could move this into. Obviously GRAT returns back to you, but unless you have that weird limit where you think something's going to drastically go up and you just started and it's showing, a lot of value, there's probably not much to be thinking about doing in that lower net worth range.
Yeah. So a couple of thoughts on that. And you do a great job on this on your Twitter account in terms of getting people sort of indoctrinated into these concepts. If I've got clients who are in sort of that 2 million range, the type of wealth is important here. If you've got a business that you think is looking to shoot up in value. And by shoot up, I don't mean double. I mean, it's sort of, although that would be nice, but if you're going from X,
20x.
if you're going from X to 10x, I would spend a minute just thinking about what that looks like and what you think your net worth might look like in 30 to 50 years. It might be worth it to think about doing a little bit of planning around that. From an estate planning perspective, if you think there's something there. But what I would say is that at the 2 million level, you're starting to creep up in different states around the state estate tax exemption. So here's a horrible surprise for some people. There are some states that have their own estate tax. I live in New York and
Washington, right?
Yep. And it's Illinois is another one that's particularly nasty. Well, in New York, we have a really mean thing known as the estate tax cliff, where at $6 million, it's around $6 million right now. And there's a little complication around this, but for purposes of here, at $6 million, once your wealth creeps over that, then you get taxed back to $0. And so if you ended up with, let's say, $6.5 million and you ended up getting, I guess it's the 10 to 13% tax on that, you're talking about a big number. And if you can find ways to bring that number down under 6 million, you could be, saving $250,000 right away.
Yeah, it's 6.5. You could go spend 800K or 6 to 800K and end up in the exact same spot.
That's right. And there are ways, we advise New York clients around that. Obviously, number one is move. But then secondarily, being smart around gifting. There's a possibility of using that to help plan for things and all sorts of components. If you've got outside real estate, sometimes that doesn't count toward it. And there are those types of issues. All of which is to say, just because you don't see 13 million on your horizon doesn't mean that there aren't benchmarks that you have to worry about at the state level. Additionally, there are lots of great tools. Most importantly is the annual exclusion. So you can give $17,000 to as many people as you want without
and per spouse too.
That's right, per spouse, and that is a extremely powerful tool for getting assets to different people in different generations without having it bite into your gift and estate tax exemption. So for those people who are in the 2 million level, and if you're 30 years old, I agree with you. There isn't a ton I would be extremely worried about on that front from a pure estate tax avoidance issue. But if you're older and you're starting to creep up towards some of these limits, the exclusion amount, that's $17,000 per year, that can be a really powerful component.
Yeah.
And then I would also say that another tool that I think is significantly underappreciated is the use of intra-family loans. If you have a chunk of assets that you wanted to give to your kids, but you're a little worried about that, the idea of loaning them the money
At a low rate,
at a low rate, not only low rate, it's a clear low rate. The IRS puts out a list of applicable federal rates. So creating an arm's length transaction is a great way, I think, just from a family governance perspective, to get assets to the next generation and help teach them about being good stewards of the assets and understanding the concept of repayment versus entitlement.
Yeah.
So
even today, that's 5.2 relative to like, hey, they're going to get a mortgage. You got a ton of money. Maybe you are the bank versus an 8% mortgage.
It's the delta between the AFR and mortgage rates previously wasn't that big a deal, and no one really cared. It's a big deal now. And for younger people, maybe just starting out, this is a way to get them involved in home ownership more quickly. Or
they don't need the down payment now, really. You can fund the whole thing. So the barrier to entry is even easier.
No question. And then for those people who are starting businesses and so on, it can be a source of capital too. And again, an arm's length transaction, so that it isn't the type of thing where, son or daughter comes up expecting things to be handed to them. Having a very simple note structure around it is a powerful, not only estate tax tool, but also sort of family development tool.
Yeah, no, agreed. And a few things I want to hit on too. I think people get confused on the gifting amount, like the per person. Like if you have, married son to daughter and 3 kids, you have 34,000 you can give to each person in that family. So I think people hear these numbers and they're like, well, that's not impactful, $17,000. But when it's both spouse to both people, I mean, it starts to end up being a lot of money that can be super impactful.
No question. And it also doesn't count against paying for other people's tuitions. So you start, let's say you're going to a private university bills. Or medical bills. That's right. And if you are interested in getting resources to people in a usable way quickly, 34,000 plus tuition, you're well over 100,000 at a private university, let's say, at that point. And that's meaningful even to the really wealthy. And especially if, it's 100,000 per person and you've got 4 kids, et cetera. I mean, that's real money. And, again, we started out at, the younger person at 2 million. That advice holds just as true for people at the 5 million, 10 million on up. That can be a big way to efficiently and thoughtfully get assets from one generation to the next.
Yeah. And I think the other important point that you made too, that I thought about, but I didn't think it'd be as big, as the 2 million net worth. It actually still might be a good opportunity to move things out of your estate if it is a booming company. Because I think what people forget is that, let's say, a very small part of your net worth is this business idea you're just starting, but you're starting to realize like this is a very promising idea, right? We haven't grown, we haven't brought in revenue, we haven't taken on anybody, but we're seeing that, wow, this could end up being really big. Moving some of that ownership into a trust locks in the amount that you moved out, right? So if maybe that's a few $100,000 today, but that could grow to, like, for example, I have a client who their business valuation's like $80 million today. 5 years ago, it was worth like under 10, right? And so if they use some of that exemption and it grows, and that's 8x over 5 years plus whatever future growth it could be, you're able to still move a lot out of your estate that might be more than the exemption in the future.
No question about it. This stuff really works. You get real leverage on this when you are transferring assets before they've hit it big. And if you can get with anything, the papering of these things is important, and to get professional appraisals and valuations, which is probably a good idea anyway. But to get something valued at X that turns into 10X, 20X, 30X, by the time you get the letter of intent to sell, it's too late, because that looks like a pretty reasonable valuation. If you can get stuff in for founders shares valuations, those types of things, and if you're able to sort of put in those tokens at an early rate, you can really not only maximize the use of your exemption levels, but you also have potential tax planning as it relates to future capital gains. Obviously, there's lots of asterisks or asterisks attached to that, but when you're trying to sort of arbitrage between low and high tax states at the capital gains level, getting in low basis things early really makes the fact pattern that much better.
Yeah. Okay. That makes a lot of sense. I think you good to move to the next kind of group of wealth. I feel like we hit that one really well. So let's move down. Let's move to this, like, I don't know if this range is 8 to 15 or, 10 to 15. It's somewhere in this like middle wealth range, right? Mm-hmm. And I think this one's pretty applicable to me, because I'm getting a lot of people that I work with who are in their 30s to low 50s who are 6 to 15 million net worth today. And it creates a lot of interesting planning thoughts, because I think when you first talk about this with people, their first instinct is like, what if I need to live off of this? Right.
That's right.
And so I think always step one is like, what do you need to live off of? Right. And I think the way that you look at it is very different. Like one of the clients I work with, 75% of their wealth coming on is in a private stock. And that private stock is a very promising company, right? Like it's a company you feel way better about just because everybody would know it. It's a name. They're growing, whatever. Very different than, hey, I have 15 million in a diversified portfolio that I've, built over time. A couple exits went to cash and I moved it there. But it is interesting to think about how to do this.
So, and again, this is less gizmo related. There's lots of things we can talk about as far as trusts and all that stuff. But really the bigger issue to me is, you've diagnosed it perfectly, is understanding the financial planning component of it, which is, sort of gaming out on a spreadsheet or however you want to do it and saying, okay, how much do I really need to live off of? And then, so once you sort of figure that part out, and then you can start figuring out, okay, what can I comfortably give away? Then you have to really start thinking about, you really well diagnosed, is, what happens if, what happens if this company, which was very promising, suddenly really has a toe stub? We're not that far away from FTX. We're not that far away from Enron. We're not that far away from Kodak, all of which seem like either, well-established and, things you could rely on no matter what, or seemed promising and then suddenly weren't. And one of the things I just had a conversation with a client today where, the idea was, okay, if you're using certain assets for your estate planning, it's a really good idea to know as much about it as possible and be confident. I wouldn't call it a mistake, but an unfortunate thing that happens occasionally is that people put assets into these trusts and use gift exemption. And then all of a sudden, they turn to zero. And then all of a sudden, you've not only lost the value of the asset, but you've also lost the power of that particular gift exemption. For those people in the 8 to 15 million range, on up to, let's say, a double taxable estate of 25 million plus, again, I think it's, I don't know if I'd call it irresponsible, but I would not want to put everything into estate vehicles to avoid the estate tax at the exclusion of making sure you have the right amount of personal liquidity, et cetera. And then the other part too is really I think really understanding the stability of the family unit itself. One of the biggest, what I call divided by twos, is divorce. And I think it's important not only to really understand the dynamic of what's happening there, but understand what happens if you put things in structures that benefit spouses and then kids going forward. You could complicate your life significantly if you get divorced in 5 years, and everything you've done was built on the notion of a congealed family unit, and then suddenly it isn't. And that can be painful to unwind. It can be expensive to unwind. And look, life intervenes, and I'm not saying don't do it because you're married, but I'm saying that the idea
Gotta
of
know that.
the idea of not doing everything in its own silo, sort of the marital and financial planning on one side, the estate planning and planning for the kids on the other side, et cetera. Again, they shouldn't happen in a vacuum, because there are times when those outcomes can be very interrelated.
Yeah, that's an interesting point. Obviously, really important to think about. I think on this note, I mean, business ownership makes sense again, right? Like if you have a growing business and you're in that net worth range, like moving some of that out, especially if you're going to be holding for a long time, makes sense. I think some of the hard ones are the ones you talked about, right? You have a private company that could, it could grow a ton, but it could decrease. It is a risk, right? Losing some of that exemption would suck. But like, again, I'm working on a household now that we're trying to bring on, who like family has like $35 million, and the mom has most of it, right? And 80% of her wealth is in 4 stocks. And so it becomes really interesting, because obviously you try to do all the great financial planning and you're going to have like, whatever, all the strategies around avoiding capital gains. And so you start to think like, well, would this be a good thing to go put inside of a trust if it's, one of the big names where they've been growing at 30 to 40% a year for the last while, that could be really good. But it's also like, for example, even Google, like Google is amazing, but is Google going to be worth X amount in 20 years? And there's still taxes associated with, selling and making changes inside of these trusts.
Well, you bring up a really good point, which is that the interrelationship between capital gains and estate tax is important to think about, because very often the things that we use in terms of gifting assets into a trust, you remove the step up in basis upon death. And for a lot of people, real estate investors know this acutely, the idea of using that step up in basis at death to avoid capital gains tax to
Huge.
pass assets on to the next generation is a major component of their decision making. So on one hand, you have the capital gains tax over here, and then on the other hand, you have the estate taxes over here. That's one where certainly at the ultra high net worth level, but definitely that middle wealth level, where gaming out exactly the difference between what happens with the capital gains tax versus the estate tax is important. And then that gets back to the longer question of what are my time horizons, and then the choice of assets, so that for certain estate tax vehicles, maybe those assets with a higher basis are the ones that belong in there, so that any capital gains tax sort of liability that's in place isn't as significant as the estate tax savings that you're creating. Whereas the real low basis stuff over here, maybe that's the thing you want to hold on to, so that when you pass away and it goes on to either the spouse or to the next generation, that step up in basis happens, and then the capital gains is much less of an issue. And hopefully,
Right.
you've been able to sort of model the estate tax ramifications around that. So it comes down to math, but there's some art and science to it as far as choosing assets, and then also sort of understanding what you can and can't do with the capital gains tax hit when you're doing these longer term estate tax planning situations.
Yeah, really good point. So it sounds like in this group, first group is kind of like, there's probably not much to do unless you're the rare breed of like rapidly growing business super early on. This group, it seems like it's hey, financial planning comes first. What do you need to live off of? Like, don't just for estate tax purposes move things out of your estate, and then all of a sudden 15 years from now, you're like, I had 10 million, I moved 5 out, 5 of mine has decreased because it, whatever reason, now I have $3 million and we can't retire because, or we have to go unwind or make all these changes that, maybe don't work, maybe are expensive, all of those complexities. But if you have the financial planning done to know you have X amount that can move out, moving it out now ahead of 2026 does start to make a lot of sense.
Yes. And I'd add one more thing on that, especially for people with private companies, because we talked a lot about sort of X to 10X and that type of thing. The concept of buy-sell insurance, I think, is a very useful thing to think about. Most people think of life insurance purely on sort of a replace income slash pay for estate taxes. You start getting into the world of insurance as an asset class. That's a whole different discussion. But the concept of a buy-sell agreement, though, is important, because if you're in business with somebody and they pass away and their shares go either to a spouse or to their kids or so on, that may not end up being the operating governance that you want for that particular company. And buy-sell insurance at the company level, I think, can be a very useful discussion to have, so that the liquidity is available when someone passes to buy those shares out from people that you don't want to be part of the running of the company, and the company can move forward. It doesn't have to be an all or nothing thing. There may be talent within the rest of the remaining family of the person who dies, et cetera. But for that sort of 8 to 15 million, building the business, et cetera, the buy sell insurance part, I think, is a good necessary discussion around that.
Yeah. I mean, I talk about it with all of our business owners. And I think that's probably something that we have to do an entire episode on, because I think even when you bring it up, people are like, I have no idea what buy sell is. But then you bring up the whole pain point of, well, hey, if your partner passes away, do you want their spouse to run the business? And they're like, no, they wouldn't do that. And it's like, they might. You can't say that they wouldn't step in and be like, I have to make decisions, or you're making all these decisions without me. Typically you want to keep it clean, but good add-on.
And you don't want to have to buy them out with current cash flow, because that's suddenly you're feeding hay to a dead horse. And it's not really, you're not allocating your cash flow toward growing the business anymore. You're trying to solve for what was a solvable problem before.
Yeah, really good point. Okay, anything else to hit on in this group?
I don't think so. The main point, I think, also is to make sure that your documents are up to date. Many times in the 18 to 15 million range, we're starting to get in the world of 50-year-olds and so on. A mistake that I see very often, and I'm sure you see it too, really falls into two situations. The first one is that the estate plan doesn't reflect what currently exists. It was in place back at age 30, age 40. The kids are different. Maybe they're married. Maybe they're not married. Maybe
you have more kids.
You have more kids. Maybe you're on a different spouse, and maybe everything is left to the first one. That's not an issue. That's not an uncommon problem, believe it or not. But getting those documents reviewed and up to date, I think that's a good, when you get to age 50 situation. I wrote an article about, times to look at your estate plan. I mean, I would say you should look at it all the time, but the main thing is around births, marriages, deaths, change in employment, change in business, those types of things, and then moving, and then change in law. And those merit a review of what's in place and what's not. Then the next part is that, that's just sort of making sure everyone's taken care of that you want taken care of. I think the idea of understanding who staffs the different roles, in particular, executor and trustee. Many times people fall out of love with their friends and so on. And the people that were meant to be guardians, maybe you're not on close terms with them anymore. Or if you have people who act as trustees of certain trusts, who, maybe one of them had a stroke, or maybe one of them developed a drinking problem, or they don't want to do it. That type of thing, it's not a bad idea to review that, because the people who staff these functions occupy very high work, stressful roles with liability, whether they know it or not. And to make sure that you have the people in place that you want in there is important. So in that 8 to 15 million range, really for anybody, but there in particular, because they get to it, that I'm sort of surmising that they're at a certain age level. A lot of changes happen real quickly at that point in time, and it's worth reviewing and making sure that the people that you want in there are correct.
Yeah. Good point. Okay, so let's move to this like ultra high net worth range. And I think maybe the best place to go is well above 25. Because I think if you go to like 20 to 25 to maybe even 30, it's pretty similar to the range we just talked about. But I think when you get to the like 50 plus million, I think it does change. And I'm curious here for you, but in my mind, when I'm thinking through this, I'm like, use all 25.9 now, right? Like, because that's going to end up being able to give you way more through that growth as long as you have the ability to. Because if not, I mean, obviously, if you can't do that, don't. Financial planning comes first. We've hit on that. If you do 12 or 15 or whatever, and it's still more, that's still good. It's going to grow and still be more impactful. But there's a very good chance you're never going to have room to do 25.9 in like basis.
Right. So I think when we start getting into those realms, job one is to make sure, in my mind, and this is a sort of back of the envelope discussion, that if the market corrects 40 to 50%, or if you have a divorce or some sort of the wealth is cut in half, that the estate planning you did moving assets out where theoretically you have less access to them, that you aren't brought up short. And again, I say a 50% haircut because I think it's not only possible, it's happened not too far, not too long ago.
It's probable to happen in your lifetime.
Right. And so I think that is an appropriate stress test to make sure that, you know, what you're thinking about putting in place is going to work for you over the long haul. And again, now when we get into the ultra high net worth, where, you know, it's like 200 million and you're giving away 30, then it's not that big a deal. But it's that stress test, I think, is important from a financial planning perspective in deciding whether the structures are in place. Secondarily, I think then too, you know, if you're having the discussion of where people are in their lives and they can't spend it all themselves, and they're starting to really worry about legacy issues, the planning we're talking about is sort of let's call it subsidizing or maybe endowing the legacies of the kids, making sure that they have the resources to lead the lives they want to live, et cetera. And that can mean different things to different families. When we really start getting into that level too is using charitable structures. Charity is it's an important thing for a lot of different reasons. I'm a big proponent of using charity in one's planning and philanthropic structures, et cetera, not only as a way to, you know, get tax savings, and the two big tax savings, whether it's through charitable remainder trusts or foundations, et cetera, is to remove low basis assets and not pay capital gains on them and use them in a charitable context, but then also to get deductions for those gifts made. So you get kind of a double plus on that front. But I view the philanthropic part, and sometimes this gets overblown, but I really like the idea of using the philanthropy as a way to not only sort of provide a good example for kids and provide good learning tools for kids without having to deal with larger, bulky business assets and wealth, but it's also a great way to define oneself within the community and to establish their legacy in that particular context. And this is less tax related, but more sort of an idea for people in terms of garnering the discussion with the next generation and getting some impact back and forth to try to mitigate future conflict. I really like the idea. If you have $5 to give away, and for people listening, you can add as many zeros and commas onto this as you deem appropriate. If you had 3 kids and $5 to give away, I really like the idea of giving away having a kid give away $1 to something that's important to them. It provides a lot of data to the parents. They understand it's important to their kids. It provides a lot of data amongst the kids. They understand what's important to them. And then it also provides some sort of low stakes understanding of what money can and can't do and the leverage it can provide for causes that are particularly noteworthy. The $4th to give away, I would have the 3 kids give that away jointly. Why is that important? Because it gets them involved in having discussions around wealth and values. And that if they start to come together and can make a productive decision around that, you're sowing really good seeds for them later on when they are attending the reading of the will, and they need to understand the context behind why certain decisions are made, either at the estate planning component, or if there are decisions made to either favor one over the other or put somebody in one context versus another.
And maybe there will be a bunch of money in a donor advised fund or something that they have to distribute together too. You never know.
No question about it. And then the fifth
I love
dollar.
that, by the way. Parents ask me all the time about good ways to teach their kids about money, and I have not thought about the joint group of that. I love that idea.
And to add on to and that's just amongst the siblings. The fifth dollar is to have the parents and the siblings give that dollar away. So you get to have not only a joint, the siblings can kind of, talk amongst themselves, and they get, that can be productive in not having the parents in the room kind of way, but then one in which the parents can sort of impart the values that they received from their parents, et cetera, and then have that joint decision happen. Then suddenly you're really cooking with gas, I think, by having communication not only amongst the siblings, but amongst and between the generations. And so when you're putting together the larger estate plan and you're transferring big, bulky wealth from one generation to the next, there's a lot of context, and I'll put in quotes, why behind things are done the way they're done. And there's less potential confusion as to how things, quote unquote, should be in administering the wealth going forward. And ultimately, I think you characterize that around philanthropic pursuits. I think you have a really good chance of either affirmatively or in a backdoor way creating productive community oriented people. And my guess is that most people would like to see that in one form or another with their kids.
Definitely. I mean, I love every part of what you just said. That's definitely going to be a clip I'm cutting from this, is that idea with the family, because I think that's just like genius. Because I think the thing that we hear from everybody is like, don't give money to your kids because there's going to be spoiled and terrible kids. And it's like, sure, that's possible, but there's also really good kids, and there's also really good ways to do it. Like, it's not all of a sudden like wealthy parents always have terrible kids or poor parents always have good kids or whatever, right? Like, it's still the quality of the people, still the quality of the teaching, and still part on the kids to choose routes of being a good person and all of those things. So I love that.
I was going to say, I mean, there are no guarantees with any of this, but what you're trying to do is create the best situation you can with the tools you have at your disposal. And if it's important to you to impart certain values that got you where you were going, or if you were talking to the grandparents created the wealth and so on, and you want to get those values to the next generation, that's a good low stakes way of doing it. I think just on top of that, when we're dealing with family businesses, let's say, that's a little bit trickier, because you have a lot of people who depend on family businesses oftentimes for their own net worth, their own cash flow, et cetera. I would involve the kids secondarily in that. And usually, sort of a tried and true way of doing that is having the kids work in other places so that they can operate away from the warm blanket of the family name in a particular family business, and sort of develop their own accountability tools, et cetera. But to rely on the family business exclusively to teach the hows and whys of wealth and the estate plan and all that type of thing, you can get into trouble with that if done exclusively that way, because there are going to be some kids that enjoy working in the family businesses, some who take a different path, and then there's some people who for one reason or another, they may be able to do it but don't want to, or they want to and can't. And when you have businesses where lots of other people and lots of other constituencies, I'm thinking employees, vendors, customers, et cetera, rely on the smooth functioning of that business, you want to make sure that you put people in place that are qualified and want to be there, and not use it as much as a teaching tool. Why I think having the philanthropy component is a nice way to get people involved who may not fit exactly in the ownership/operational succession of a family business.
And I mean, it's just a completely different mindset. Like, let's make decisions about how to gift money is very different than like all people fighting to run the business. I mean, we've seen Succession, right? Like, there's plenty of issues that are created from that.
No question about it. The other part too is that family members who you can have family members who are everyone wants the business to do well, but they may not be completely aligned. Some family members want to take cash flow out and support their lifestyle. Other ones want to see reinvestment in the business and have it grow and develop EBITDA and do something else with it and that type of thing. And they're both valid and they both have to be dealt with. But that is a conflict, and as well-meaning as that conflict is, that's one that has to be developed, and that's why getting siblings to operate amongst themselves, maybe in a different venue, like say a charity or philanthropically, that gives them context for what's happening on the big bulky asset side, so that when it's laid out that the ultimate plan comes out, there's less chance of a surprise. May not completely absolve conflict, but at least there's some knowing and some potential for mitigation going forward.
Exactly. Yeah, that makes sense to me. Okay, cool, Frazer. Anything else that you want to add here on, anything we talked about today or this last group before we wrap up?
I think it really goes back to the 2026 part. I think from a practical perspective, I think now is a good time to lock things in. Not just from get things done transactional basis, but when 2025 rolls around, assuming nothing in particular changes, you're going to find that the ecosystem of advice, the lawyers, the accountants, most specifically the valuation experts, which for those of you who are listening, the valuation experts in many ways are the most important part of the process, because that is the note from mom that you're going to show the taxing authorities, et cetera, when you're dealing with all these different values. And it's required to have that professionally done and to have a professional process around that with a good valuation firm.
So good time to get into that business.
Oh, I think if you want to be hedged on complexity, be a part of that. But the big thing to me is that I wouldn't wait till 2025, because if nothing else changes, everyone will be dealing with that. And you don't want to be late to that party when you're trying to get the attention of certain people. And, John Q. Lawyer's got a $200 million client that they're working on, and you're worth 15 million. Suddenly you're in a pecking order, and the stuff will get done. But you're adding a level of stress that you don't necessarily want.
Yeah, exactly. Okay, cool, Frazer. Really appreciate you coming on. Everybody, we appreciate you listening. Last plug for Frazer. He has a great Twitter. It's at Frazer Rice. There's 2 R's there, Frazer Rice. And then his podcast Wealth actually is also really awesome, as well as his book. So I urge all of you guys to go check it out and learn from him, just like I have. Frazer, thanks again for the time, and everybody, see you back next week.
Thanks for having me on, Tom. This was a lot of fun.